Okay, welcome to Understanding Market Risk. My name's Mike and I'm the owner of Satoshi Trading. Today we're going to talk about understanding market risk. Okay, so what is market risk? Market risk is also known as systematic risk. Refers to potentials for investors to experience losses due to factors that affect overall performance of the financial markets. So COVID was the last time that we had a systematic risk. That was the last time we had a big upset for the financial markets. If we have a recession this year in 2024, that also will be a systematic risk. All markets have risks in them. That's the reason why cryptos are looked upon from people who don't know what it's all about. They don't even understand normal traditional stock markets or financial markets like forex markets. They seem to think that crypto is a scam because they see so many people saying, "Yeah, I put all my money into that and I lost it all." Well, these people don't understand risk or mindset or have any ideas or a trading plan or price action, market structure, supply and demand, anything to do with trading that's crucial for them. They have no idea what they're doing. They just see all the friends throwing money in it and they think that they can do it too and get rich. And this is where they get burnt because they're putting in money in right at the top usually, and they see all these candles going up dead fast. It makes you want to act. It does psychologically. I've done it. I've gone in and it's been up for freaking days, and it's about to be announced on Binance. We're thinking it's going to go to the moon. It's gone in, dropped down 97%. Just boom, one candle, done. It's over. You just lost all your money. It happens. So understanding risk will help you to eliminate that by understanding that as well, and not putting all your eggs in one basket and having diversification. This will help you then to make more informed decisions. Right, so types of market risk. You have equity risk, the risk of loss due to maybe a drop in the stock or asset price, which means some bad news comes out or something like end of year comes out for stocks and that affects the price. Some red news comes out for assets like risk or forex, the finance markets, and that crashes the price. As well as that, interest rate. We've had that happening this year. That's the reason why I'm talking about it. So what happens is the risk changes in interest rates and it affects the fixed income of things like bonds. Some when the bond markets like they've been going like completely opposite to Bitcoin this year, they've been going down and everything's been sinking in the dollar. So Bitcoin, because of that, has been riding high with the SPX and the NASDAQ. So you need to understand that having your money all in one area and say, well, put it all in, for instance, the dollar. The dollar's making 7% a year. We're happy with that, blah, blah, blah. It crashes. It puts you at risk because you've not diversified your account and you put it into different things to let them just roll over if you're going to invest. You're then going to have, like I said, all the eggs in one basket, which is going to cause you to lose a lot of money. Currency risk, the risk that a foreign exchange rate, in the fluctuations from the rates, they have a high spread in Forex. It's the reason why I don't like trading it much. For new people, I think Forex is the hardest one to learn because of the spreads, because it's so hard. And the fact that there's so many whales, institutions using trillions of dollars of money every day, you you stand no chance with a couple of $100 to do anything. If you get in at the wrong time, they come in, they put an order in, you're liquidated. They took your money and they're carrying on the direction that you originally wanted to go in. So you've got to understand that the rates for foreign exchange will fluctuate from time to time. It will have a negative effect on your investments. Understand that. So inflation, recession, these things, as well as GDP growth and unemployment rates, will affect the markets. I don't care how good of a trader you are, if you do not check this shit, you will not make much money. I used to ignore this and think, oh, I know better than that. I'd get in a trade and go long, and some red news would come out, and it would flatten me. I'd lose most of my account in one day, and I'd not understand why. So you've got to understand that economic changes have an effect on the market as well as that political events. elections, government policies, geopolitical tensions, like the wars that's been going on, they cause market volatility. It means that the market will go up and down quite easily without a push, without a strain. At this moment in time, Bitcoin's finding it hard to go down because of the pre-bull market, and we've had this bull rally for the last 12 months. So at this moment in time, Bitcoin going down has been really difficult. Everyone who's a bear is having a really hard time this year. But things like this will make a difference in the markets. Natural disasters, pandemics, international conflicts as well, global events. You've got to understand that it all makes a difference to your portfolio, your investments, as well. Technological changes, advances in technology, disruptions like cyber attacks will also affect and hamper your market performance. Okay, so how do we measure market risk? Okay, so we've got to be coefficient. A measure of volatility or systematic risk of a security or portfolio compared to the overall market. This is what you've got to be coefficient in. You've got to understand what the volatility is on it, or maybe the risk of how much you could lose if that did actually crash or get rug pulled if you're in crypto. Okay, value at risk, VAR, a statistical technique used to measure and quantify the level of financial risk within a firm, portfolio, position, and over specific time frames. So it shows on this technique how much it's actually worth against all the instruments that are used to measure and quantify it. This is what this is. I know it's something you might not use, but got to understand what is the fair value for the price for the thing that you are trading or investing in. If it's below that fair price, then it's a good opportunity if you're going to invest. If it's below that price, you're looking for a trade to the long, and it's below the price, you should be looking for a trade to the upside. If it's above the price and below where the fair price you think it is for how much it should be worth, then you're looking for a short opportunity. You're looking to get rid of your investment because it's gone as far as it's going to go for now. It's hit the supply or the demand, and it's going to change, and it's going to go into the opposite direction. Standard deviation. This measures the amount of variation or dispersion of a set of values, indicating a level of volatility. So, where you see a deviation in the charts, standard deviations are usually used by a lot of the crypto Twitter people. They use that, and people don't understand why they're putting a box right through the middle of it. And people are going, is that the supply area? Well, no, not really. It's where it deviated from one side to another. Standard deviation is when it makes that move from one side to another and goes back to that center zone. That's the normal part. The deviation is up or down, whether it's one or two. Okay. Asset allocation. So diversifying your investment portfolio across different assets like stocks, bonds, commodities, crypto, forex. This can help mitigate market risk. And hedging. Using financial instruments like options or futures to offset potential losses. There is a lot of traders out there that do that. I don't agree with it, but it is an option if you do want to manage your risk, and it's one of the options you can use. I only put it in there because people are saying, why have you not put that in there? Well, I don't like it, but then I'm using it as a preference to me and not a vibe. You might find hedging quite well, but I don't like taking a trade long and a trade short in hope of which one's going to go the way it's going to go. There's a chance you're probably going to lose them both if they go up and down fast. So you're putting that risk in, instead of having one risk, you're going to be losing two risk on that one trade. There's a chance it could do that. The big candle goes up, big candle comes down, both sides stopped out in the market. Unless you've got a really big stop loss, then maybe then if you're going to use it like that, that's fair play. Regular monitoring and rebalancing. Continuously monitor the market conditions and rebalance your portfolio as necessary. As well, risk tolerance assessment. I usually do them once a month just to make sure that my risk tolerance to the things that I'm invested in and make sure it's aligned with my investment choices, make sure that my risk tolerance and my investments are on the same horizon. And then you have a long-term perspective. Often you have to have a long-term investment strategy that can help you to weather the short-term market fluctuations. So what you want to be looking for is getting into things really early. And that way, then when we do have, say, pullback, as long as it comes nowhere near where you bought in, you stay where you are as long as it's not coming towards where you are again and again and again. You've got to understand with a long-term perspective, it may come back down to go back up again and then come back down and go back up again. You've got time on the hand. You've got patterns. Traders are waiting to activate into the market on certain levels. So you've got to understand that over the long term, you will be paid better for what you take and keep in your wallets. That's where investments come in and not trading all the time. It's what I teach the moderators when we first started, that any profits that you make, start buying tokens out of it that have already oversold. Ones that you know in the long term are going to have a really good run, or maybe the ones that now are having a good run before we have a pullback. Start stacking into them on every pullback to bring your buying price down. Start looking to get into things that are ready to come down and crash. Start looking at where you could buy into them. All these things come into perspective. Okay, so psychological part. If you've not gone through the perfect trading mindset course, psychological part of this is going to be one of the key factors. Having emotional resilience and understanding market risks that can lead to high volatility sometimes will help you then to maintain emotional resilience and avoid any panic decisions based on any short-term market movements. Okay, so market risk is an unavoidable aspect of trading and investing in the financial markets. While it cannot be eliminated, understanding and managing it effectively can help you in making more informed investments and trades and using it as better decisions, helping you to align strategies with individual risk tolerance levels. Proper risk management, diversified asset allocation, and a solid understanding of market dynamics are going to be key for you to help you navigate through the market risks. This is Understanding Market Risks, and I'll see you on the next video.